Last week saw significant turbulence on Wall Street, triggered by a crypto crash that unsettled broader risk assets. As Bitcoin plunged, market makers faced additional pressure in an already fragile trading environment. From stocks to gold to oil, almost every asset class ended the week deep in the red. In geopolitics, traders also assessed the prospect of a Ukraine-Russia peace deal. Reports are emerging that US has threatened to stop supporting Kiev unless it agrees to a pact that favors Moscow, as that plan suggests. Now, in global markets, it was a sea of red last week, worsening a slump in cryptos. The digital assets engine is sputtering, with Bitcoin and its peers enduring a violent unwinding that has shattered confidence. Over $1.3 trillion has been wiped off the crypto markets. Bitcoin was the biggest loser, crashing over 12% last week to trade around $84,000. A 7-month low. Despite the risk off bets, gold also ended in the red, but closed above the $4,000 an ounce mark. Oil prices fell, with benchmark Brent crude falling 3.7% to end the week below $62 per barrel. The dollar has gained significantly over most of its peers. Still, differing bets on the Fed rate path have moved the dollar's needle between gains and losses. Shifting focus to the Asia-Pacific stock markets, the rout in global tech stocks weighed on regional stocks. The Chinese benchmark and the Japanese Nikkei crashed over 3.5% during a volatile week. Weak economic data points through the week, suggesting any upside is limited in the coming week. The Aussie index closed 2.5% lower, defying a broader sell-off in global markets. Bets for Indian stocks to hit fresh record highs are once again on the horizon. The Sensex ended the week nearly 1% higher. In the Americas, the S&P 500 closed 1.9% lower. The tech-heavy Nasdaq 100 sank nearly 5% from its intraday peak, its sharpest reversal since April. Nvidia at one point shed nearly $400 billion despite beating earnings expectations. The AI darling stock is heading for its steepest monthly decline since March. A Goldman Sachs index of retail-favored stocks has fallen 17% from its October high. The story for other stock markets in the region was no different. Now, across the Atlantic, all European benchmarks closed out last week in the green. The German DAX was the biggest loser, with a 3.3% fall from the economic troubles in Europe's growth engine. The French CAC fell 2.3% and UK's FTSE index closed 1.6% in the red ahead of the budget. Now, having looked at market moves, let's now turn to the overall economic outlook. In Asia, Chinese data shows momentum fading into the final stretch of the year. China's key activity indicators continued to slow across the board in October as policymakers appear to be delaying further policy support. Instead, China's central bank is likely to conserve ammunition for next year, depending on how the trade scenario with the US plays out. Trump's trade rhetoric continues to weigh on the outlook for most of the other regional countries despite recent deals. But India still remains the bright spot, with momentum indicators pointing to a healthy speed of growth. More positive numbers are expected from a trade deal with the US, which President Trump said is almost done. In the Americas, the buzzword is uncertainty. The US said jobs data will be released only 10 days after the Fed meeting. Expectations are for a deep divide within the Fed, with bets swinging between a cut and no change next month. The central bank is worried about driving in the fog from the lack of data. Elsewhere, the outlook for Canada, Brazil, and Argentina is still negative because of Trump's brinksmanship. In Europe, every place in the region is seeking to push through much-needed reforms. Europe's growth engine, Germany, is still stuck in stagnation. Finally, the German government has agreed on several measures that at least show a willingness to act, even if a bigger master plan is still lacking. UK continues to struggle to fill a budget black hole. The size of most economies in Europe are still well below their pre-COVID levels. European countries quickly need a clear, longer-term strategy and less wishful thinking with full pockets. All right. To discuss this further, I'm now being joined by Ankush Sabharwal from Bangalore. He is the founder and CEO of Corover and Bharat GPT. Welcome to the broadcast. I wanted to begin with your views on how you see the AI jitters playing out this week.
Hey, thank you, Shivam. Great to be here as always. Shivam, yes, so we see the market downwards, and most of the AI native and AI focused companies. But you see the Google was still up, and even Apple was still up. And I was looking at the market. So Apple and Google, they were up last. If you see last 1 year, 6 months, last 1 month, and even last 5 days. But yes, the stocks like Nvidia, uh, Oracle, they were down 5 days, 1 month, and a quarter, and even 6 months. I think all these tech stocks were up. I think yes, there is kind of uncertainty because now the new tech, the Gen AI, is around for more than 3 years now, and still we have not seen the real value in using AI. But I'm very positive. See, the technologists and the innovators and industrialists are trying to find the real life use cases of AI. Technology is real. Yes, it's taking time to find the use cases and solutions of this technology, but it will definitely is coming. And I think that in the long run, I don't see we are going to be negative. So yes, it's uncertainty is definitely there, and people probably trying to correct the valuation. But I think nothing to worry about. Even this AI tech stock, we are going to see the impact, positive impact of these AI companies in the sectors, the critical functions which we live on. So
Understood.
like we will see the impact of AI in healthcare, education, travel, BFSI, in all the sectors which currently exist.
Understood. And Ankush, if I understand that correctly, you suggest that we haven't fully tapped into the abilities of AI and where all it can be utilized and where it can be helpful. But there are fears surrounding AI. There's fear around a tech bubble. Do you find those justified?
Absolutely not, because this is definitely the real technology, as I said, and few use cases are definitely coming up. See, it is even to the cancer detection, and you see the how the robotic operations are happening and how the things are getting streamlined. I definitely don't see this as any kind of bubble which is going to burst. But of course, the pie of AI and the reach of AI is going to increase and going to go deep across all the possible sectors, and new sectors would also be coming up. It's all for the good of the society and of course good of the businesses.
Ankush, if we move a little further from there, your take on many people calling investing right now as more of a gamble. How do you see that?
I think for short term, I still see if the if the vision, or if someone needs to see the results in next 12 to 18 months, yes, it can still be risky. But for the longer horizon of say 5 to 10 years, if someone can be invested, I think we should. I think I would say this is the time to buy.
All right, Ankush, thanks so much for joining us here. That was Ankush Sabharwal joining us from Bengaluru, founder and CEO of Core Rover and Bharat GPT. Pleasure speaking with you.
Thank you, Shivan.